Hey guys, lots of weak economic data out there for the regular listeners, followers or readers of our blog. You'll know that we've been anticipating this and talking about it for quite some time. Our view has always been that the Reserve Bank would have to drop the OCR this year based off very weak economic data in the June quarter, and that has eventuated. It's been interesting to see the bank economists bringing forward their forecasts now that they can see the weak data. I wish they could forecast better. Look, we had CPI numbers out this week, and it was weaker than expected by the Reserve Bank. It came in at 0.4 versus their forecast at 0.6. Interestingly, if I take the last 3 quarters of CPI data and then annualize that, I get 2%, which is well within the RBNZ's target limits, right? So as far as I'm concerned, inflation is under control. It's interesting that the media hasn't quite picked up on that, and that they're talking about annualized inflation still being over 3%. The outlier here is the September quarter last year, where inflation was 1.8% in the quarter. That's what's holding this number up, and it seems ridiculous to me, plain stupid to me, that we would talk about inflation being higher than target when what's driving that is a number that squarely sits in the high inflationary period that we had last year. If we take a broader look at things, there's been a whole lot of bad data out there. Retail sales are down 4.9% year on year, according to latest electronic data. Retailers are doing it tough. We all know that. We had the construction inflation number come out, and I think that was negative for the first time, which says certainly that construction inflation is under control, but also reflects just how tough that sector's doing it at the moment. We obviously had very weak food price inflation coming through as well, which is good just in terms of supporting that theme of low underlying inflation. Probably of more concern is the very weak GDP signals that we're seeing in that June quarter. ANZ's truckometer for heavy haulage, which is the big trucks that move stuff around the country, that was down about 5% month on month, and it's down 0.9% year on year. That's certainly indicative of us being back in recession, or maybe never getting out of recession. A very, very weak number. House sales were particularly low in June, down 35% in Auckland year on year, and I think it was about 20 to 25% across the country. So very, very weak data. We also had the BNZ PMI index, which is a performance manufacturing index. That was in recessionary levels and one of the lowest levels that they'd seen since the GFC. They have another index, the PSI index, which is a services index that looks at the service sector, and that was the weakest number since records began 17 years ago. This is all very indicative of weak GDP. But bear in mind that this is for the June quarter. It's not going to get reported until late August. I think we're going to see a continuation of very weak media headlines around the economy for another 2 or 3 months. But the light at the end of the tunnel is getting a lot closer. Most people now are talking about the Reserve Bank dropping the OCR in November, and pricing the 0.5% fall there, increasing risk that the OCR could actually start dropping sooner than that, which will be good for mortgage borrowers. And certainly, look, once the OCR starts to fall, it will fall quite fast. A neutral OCR is 2.75%. So given the slowdown in the economy, the Reserve Bank should be in a bit of a rush to get the OCR back to 2.75%. That would take mortgage rates back to between 4.5% and 5% at some point over the next 12 to 18 months. So as mortgage borrowers, that's what you've got to look forward to. As far as the housing market's concerned, obviously it's quite weak at the moment. We are in winter. There's been about a 25% year-on-year increase in listings. So more people are listing their properties and less of them are selling. House prices are reasonably stable. They're down about 2 to 2.5% in the last 3 months, but if we look year on year, they're still up slightly. But we're, in real terms, since market peak, we're probably, in inflation-adjusted terms, we're still down probably about 30%. 30-35%. So I'm expecting to see a little bit of price recovery next year as those lower OCR rates start to kick in and we get a little bit more consumer confidence as consumers find they've got a little bit more money in their back pocket.